for us to network. Welcome. As is typical in most countries, and people think, oh, maybe in the US or in Germany, small businesses and startups don't have trouble getting finance. But it's, of course, not true. I ask people, what country has the most active startup ecosystem? And most people will say the United States, the Silicon Valley and everything else. People might argue other countries as well, but certainly the US is one of the biggest startup areas. It's also, the US has more equity finance, including angel investment, private equity, venture capital, corporate finance, than any other place. However, people have a perception that in the United States, if you have a startup, you'll get financing. But the reality is that less than 1% of startups in the United States get any form of external finance. Not just equity, it includes debt. So, and less than 2% of all companies in the United States get an equity investment in a given year. So, how do companies get funded? Well, as has been the case for 10,000 years and probably will be for the next 10,000 years, the majority of companies either fund themselves with their own savings, with their retained earnings, or through debt, they borrow money. So equity has an important place, but it's not the only form of finance, obviously. Today I'm going to talk about how to mobilize money for those businesses that have trouble getting money of any kind, whether it's equity or debt. I'll use the example of the Kosovo Credit Guarantee Fund, which has been very successful, but it wasn't an easy road to get there. I think it might help to know a little bit about who I am. I'm the managing director of Crimson Capital, which started as a US company, but then when we started doing the foreign investor privatization in the Czech Republic, we established a company there, and so we're also an EU company. We have 3 finance funds, one in North Macedonia, one in Kosovo and Albania, and these funds finance directly startups, women-owned businesses, agribusinesses, and early stage companies. I also happen to be the founder of STIC in Kosovo. There was no IT association, and saw a need and worked with the companies there to do that. I was co-founder of the Innovation Center, and other things. My background is as a research scientist. I managed research technology institutes at University of California, Los Angeles, and University of Southern California. But here at the World Business Angel Investment Forum, a lot of people call me the black sheep. And that's because I think everybody was probably at the grand opening this morning. You heard Baibars as always say, the only smart money is angel investors. The only type of finance for startups is equity. And nonetheless, Baibars invites me here every year because I talk about debt. So I'm sort of the black sheep. But increasingly you see at these conferences, including the European Business Angels Network conferences, talk about different forms of debt, either in conjunction with or instead of equity. Businesses that grow rapidly need more money, and you can't actually sell more than 100% of the company. So you can only take so much equity before, if you're going to continue to grow, you need debt financing. Crimson Capital, really quickly, we were formed in 1991, and we do private sector development. So we work with governments for privatization and foreign investment, public-private partnerships. We work directly with businesses. We work with central banks and banks to help encourage them to lend more progressively. And we work in a lot of different sectors. Overall, since '91, we've mobilized about $7 billion of capital into emerging markets. And our finance funds in the 3 countries have financed over 1,400 companies with about $70 million, and over 200 of those were startups funded exclusively with debt, not with equity. So it's very interesting to me when I'm on a panel with equity funds of one sort or another, and they talk about over a certain period of time, they've invested in 3 companies, or they've invested in 8 companies, or they've invested in 15 companies. And of course, with equity, it's long-term, and you have to wait for an exit. And so you can't do as many, can't finance as many companies as you can with debt when you lend money and you get repaid and you can lend it out and it revolves over and over and over again. From a fund perspective, also with equity, you have no return, you have no income, except as a small percentage of the funds under management, because the companies are growing and they don't pay dividends, and until there's an exit, you don't get a return. When you lend money, you charge fees and interest, and so our funds are self-sustaining on fee and interest income, and we keep revolving it. Kosovo emerged from the war in 2000. Unlike the other parts of the former Yugoslavia, Kosovo was not a republic, it was just a province. They declared independence February 17th, 2008, so today is their 12th birthday. And there's a lot of celebrations going on, not only in Pristina, but also in Tirana. But Kosovo is a small market. It only has 1.8 million people. It's landlocked, and it's a 90% import economy now. It used to be a net exporter of food, the province. Now it's a 90% importer because of the war and other things that have happened in the transition. The economy has faced a lot of difficulties. They had to create a financial sector from scratch. So when the bombing happened and the UN took over basically Kosovo as a protectorate, they had no financial sector, they had no banks, they had no central bank, they had nothing. So, excuse me. So it was literally in 2000, everything, all the laws, the institutions, all the ministries had to be created from scratch, and so it's really early stage. There's 10 banks and a number of non-bank financial institutions and microfinance institutions, and the loan portfolios have been growing year on year. The banks are highly profitable, but yet the percentage of financial intermediation is still quite low. And there are many, many companies that have trouble getting finance. The banks are very conservative, even though they're very liquid, and for the usual suspects, it's very difficult to get finance. So what is the solution? Of course, potentially there's opportunities for angel investors and for equity funds to come in, but the market is small, the average business size is small, so most funds are not going to be that interested, and that's not only true of Kosovo. So if you look at most investment funds, the question that people often don't ask is, what's your minimum investment size? Well, a lot of funds say, oh, well, we go down as low as 10 million, or 5 million, or 1 million. Well, in Kosovo, the average gross revenues of businesses is 60,000 euros. So how is a business whose revenues are 60,000 euros going to be taking investments of 100,000, 500,000, 2 million? The EBRD and IFC have been trying to invest in Kosovo, not only Kosovo, but the surrounding countries as well, for years. They started out with $10 million minimum, lowered it to 5 million, now I think they're at 1 million. And so they invested in a couple of banks, but they can't find companies to invest in because for big investors, whether institutional or funds, the scale is just too small. So where is the money? The money's in the banks. The banks are highly liquid in Kosovo and very profitable. Despite interest rates going down, the fees have been going up. But a few years ago, ProCredit Bank had banks in something like 23 countries. Pro Credit Bank Kosovo made 50% of the profits of the global group of Pro Credit. So, yes, Latin America, Africa, Central Europe. They now have, sold most of those. They've scaled back, but when they had 23 countries, over 50% of the profit came just from Pro Credit Bank Kosovo. Yes, exactly. And when you consider some of the size of the countries that Pro Credit was in other places, it's amazing. But that tells you the banks are liquid. The financial sector in Kosovo is extremely stable. They're very profitable, and yet it's hard for small business, even established small businesses, to get financing. The banks, then there's many reasons for that, but the banks, want, downtown urban commercial real estate as collateral, which most small businesses don't have, et cetera. So the question is, how do we get some of that money to help these underserved businesses? So for some 12, 15 years, Kosovo has tried to come up with some type of guarantee scheme to help guarantee the loans from banks to encourage them to lend. They've had many international quote-unquote experts. They've had many attempts from various donors and companies and other things to do it. And they couldn't quite figure out how to do it. Now, there have been successful guarantees. The USAID Development Credit Authority loan portfolio guarantees, we put the first one in place with Raiffeisen Bank for agriculture lending. It was fully utilized. It was very successful. It helped Raiffeisen do more ag lending. Then there were 6 more DCA guarantees that went in place that were very helpful. But most guarantee schemes like that, from USAID, from the European Investment Bank, et cetera, are for a finite period of time and with a ceiling. So once those have been used, you either have to create a whole new guarantee or you just stop doing it. The idea being, maybe the banks would learn how to do this and do it on their own without the guarantee. And to some extent that's true, but it really doesn't filter down to early stage companies and startups and women-owned businesses. And most guarantee schemes are not sustainable. So guarantee schemes charge fees to provide the guarantee. Those fees have to cover their operational costs and any reserves and losses. So in most cases, they don't, and either the government or donors or somebody has to just keep pouring money in because they're losing money, or the guarantee schemes eventually collapse. Now, for those types of schemes, the problem is the banks aren't stupid. They know those schemes aren't going to be sustainable. And so they might use them for a while, and then they start to back off when they realize that the guarantees might not be backed. So the question is how do you create a local indigenous guarantee scheme or fund that will have credibility with the bank so they'll trust the guarantee, but it can be sustainable and revolving long term so that you develop a culture within the banks in their underwriting of loans and in their looking at this to get more and more experience over time. And as companies that had guarantees become more mature and they don't need a guarantee anymore, the banks can then use it for earlier stage companies and keep revolving it. These are just some of the challenges to set up such a fund. The legal form is one of the most difficult. And there was an initial project to create the Kosovo Credit Guarantee Fund that was supported by a donor, number of millions of dollars to support it. And they had some top international financial experts to determine the structure and the design and the operations and the implementation of this fund. And then the donors were going to provide capital to back the guarantees. So they proposed a joint stock company. But they couldn't figure out who the owners of the joint stock company would be. They said, oh, they'll be the banks. Well, if the banks own the guarantee fund that is then guaranteeing their loans, there's a conflict of interest and a moral hazard. And that's, it's like when you see banks that are owned by one or a couple of local individuals, rich individuals, and they make loans to their own businesses, their cronies or their friends, and then of course you get huge default rates. So it's a similar problem. So they proposed a joint stock company, but they couldn't figure out who the owners would be. So then they said, oh, maybe the owner should be the central bank. I said, well, the central bank is the regulator, so they should have an arm's length relationship for some of the same and also different reasons. There are countries that have guarantee funds that are owned by the banks or partially by the banks, that are owned by a central bank or partially by a central bank. But if you look at the performance of those, it's not very good. So the question is, what legal form could there be? Then, of course, whatever it is, who actually owns it? Does the government own it? Then and that's related to corporate governance. So if the government owns it, there's likely to be political interference because, oh, there's this big pot of money and maybe they can use it somehow to create jobs and buy votes or get their cronies or their relatives loans. So that creates a big problem. If they don't own it, but somebody else owns it, but they oversee it or manage it, it can be the same problem. So the issue is independence. And how do you create such a fund that's independent, that can avoid political interference and avoid conflicts of interest and moral hazards, and therefore be credible as an institution that the banks will trust to back the guarantees? Of course, you need capital. Now, the capital, when you think, oh, if it's going to be an operating business and then you invest capital and then you get your money back at some point, you get a return on the investment. The problem that and they were proposing this, the problem is that guarantee funds are not profitable. As I said, most of them actually lose money. So if you put in capital as an investment, the chance of getting your money back or getting a return on it is close to zero, and it's actually zero. Because if you take the capital out, you don't have the capital to back the guarantees. Plus, if you're going to give a return on that capital, or if you're going to borrow money to back the guarantees or cover costs and pay interest, you're going to have to cover that with the fees you charge for the guarantees. And then the fees will have to be large, and then the banks will have to pass it on to the borrowers, and either the borrowers won't take the loans or the banks won't participate in the guarantee fund, and therefore the businesses don't get finance. There's a question, of course, on leverage. If you have $1 million and you put it in the bank to back the guarantees, and then you say, well, so we can guarantee loans up to $1 million because we have $1 million to back it. That's a one-to-one leverage. Now, that's very safe. It's low risk. But if all you're doing is guaranteeing, well, in this case, let's say it's $1 million and you provide a 50% guarantee. So you're guaranteeing $2 million in loans. That's not very much. And so the development impact, the number of businesses you can support, the number of jobs you can create are very low. So you want ideally to have more leverage, but the more leverage you have, the more risky it is, because if some of those loans go bad, then you're going to use up your capital. Guarantee percentage is very important. For over 20 years, the USAID has done Development Credit Authority guarantees around the world. I think it's probably up to $3 billion in guarantees. They are almost always 50% guarantee of the principal of the loan or less. There are a lot of people that keep proposing for early stage companies and startups, the most risky ones, to go to 70% or 80% or 90%. The problem with that is that the higher the percentage of the loan the guarantee fund covers, the less likely the banks are going to do their proper due diligence when they make the loan, and the less likely they're going to work very hard to collect the loan later because they're mostly covered. And so the higher the percentage, almost always the higher the default rate. The higher the default rate, the less capital you have, the less businesses you can help. So, and in Kosovo, it was proposed that the guarantee fund for startups do 70 or 80% guarantees, and one of the big donors that was going to be providing capital, who should know better, wanted to do that. But fortunately, I wrote the law to create the guarantee fund, and I put in the law that the guarantees cannot be more than 50%. So they realized they would take probably 2 years to get the law changed, and once you start changing the law, people can say, oh, let's change other things as well. Risk sharing, the guarantee percentage, of course, is risk sharing. But also, in the case that a loan goes bad, what happens? And there are people that propose what are called first loss guarantees, so that the guarantee fund pays the first loss. Well, again, that means that the banks have less incentive to collect on the loans because the first loss is covered by the guarantee fund. So my view is it should all be pari passu, which means equal. If there's losses, you share equally in the losses, or depending on the guarantee percentage. And if you collect on loans that went bad later, then you share the proceeds from that as well. That helps reduce the risk and makes the banks do better due diligence, collection and monitoring, and it ultimately then allows more people to get financed at better interest rates and terms because the losses are less. Operations, oh, sure, yeah, absolutely, anytime.
So basically, 50% of individual, that's the guarantee. But on the portfolio level, is it different for different banks? Or
Okay, that's a very good question. The question is the 50% limit on individual loans or also for the portfolio of all the loans in the bank, and is it different from bank to bank? So the way we did it is that, and I'll talk about the MIS system. Basically, the banks have to do certain things if they want the loan to be covered by the guarantee. If they want it to be guaranteed and it meets certain criteria, then they just include it in their database and they push send, and it automatically comes to the credit guarantee fund, and which the MIS system checks to make sure it's not over a certain amount. It won't cause guarantees to be over the ceiling for that bank. There's certain criteria, and if it meets it, it's covered by the guarantee, and automatically invoices the bank for the guarantee fee. Okay. Excuse me. So the banks will, of course, submit their group of loans, but each one is covered individually. And we allow the banks to decide what percentage of guarantee they want up, so they don't have to take 50% guarantee. The reason we do that is for a given company, it might not quite meet their criteria, but all they need to do is take a 20% guarantee to put it over the scoring, and then of course the fees are less and the interest rates are less, so the banks have that option. Now, on average, after 3 years, the guarantee percentage is close to 50%. So far, people have just been doing that. Now, so the average is close to 50% within the portfolios and bank to bank. Now, one of the things we did, which I'll get into a little bit later, but we have such a small group, it's just whatever the questions are. But, so what we did in the law, when I wrote the law, was put that the guarantee fund should be self-sustaining. Its only source of income is guarantee fees. So the guarantee fund has to be able to change the guarantee fees. And how does it base that? So it monitors each bank very carefully. The non-performing loans of the guaranteed loans, but also the non-performing loans of the whole portfolio of the banks. Because if the loans they're putting under guarantee might be doing fine, but if the bank's non-performing loans generally is going up, it's a sign there could be problems later. So on a bank-by-bank basis, the guarantee fund, with notice and there's a procedure, can increase the guarantee fee if the default rate is likely to be larger or if the NPLs are increasing, okay? And, or in a given bank, maybe the NPLs for agribusiness loans, you know, is really nice and low, but their loans to wood processing companies, for some reason, are going bad. The guarantee fund has the ability to say, okay, on agribusiness loans, we're going to give you lower fees, and on these other loans, higher fees. So, and the fees can be different bank to bank, and region to region, and sector to sector. So far, it's been kept uniform, and it's been worked out. It's worked out well, and the guarantee fees have actually come down a little bit, somewhat against my advice. I said, wait, have more track record. But anyway, it's working out, but it can be adjusted.
Yeah. Just another question.
Sure.
So basically, the guarantee fees, the range of the guarantee fees now, because you're mentioning it's different depending on the bank and the quality of the portfolio. So what is typical for, for your fund, actually, for funding a cost? So what would be the range?
We started at 2%.
2%.
Of the guaranteed amount. So, which is half the loan, so it's like 1% of the total loan value. And it came out actually a little bit cheaper than DCA, because DCA has several, you know, like a commitment fee, and there's no commitment fee. If the banks don't put loans under guarantee, they don't pay anything. Okay. And it's completely voluntary. So there's no commitment fee, there's no any of that, and no application fee. It's just, on the total loan, it had been about 1%, but now it's coming down. The MIS system, well, so if the only income is your guarantee fees, you have to cover everything. You have to cover your staff, you have to cover your office space, you have to cover your utilities, you have to cover your legal and accounting costs, and you have to cover your reserves that you have to take and your losses. Otherwise, you'll start eating into capital, and then you're not sustainable. So that's why they need to have freedom to do that. But on the other hand, we also needed the fund to be extremely lean, staff-wise and everything else. So we developed quite a robust management information system to be able to really track everything and report everything, which is complete and includes loan management, reserves, accounting, reporting. It's quite sophisticated. And the fund only has 5 people. Well, now 6, because we added the ag window, so we added an agricultural lending specialist. We're now going to add the renewable energy window. So, but there were 5 people: the managing director, person in charge of risk, person in charge of credit, finance and administration, and legal. That's 5 people. And I had to fight very hard to keep it that way, because everybody says, oh, well, don't you need a communications person and a, you know, this, and no. The guarantee fund can be lean because it doesn't interact with the businesses. So it's up to the banks. If you want money, you go to the bank. The bank works that out. If you don't need a guarantee, they don't take a guarantee. If the bank, to make the loan, if they want to make a loan and they need a guarantee, they submit it to the guarantee fund. So the guarantee fund deals with the banks, and in this case, also a leasing company.
Yeah, but sorry, are you just saying that for every loan application that a bank makes needs to get an approval from the fund?
No.
No, it's not. Okay.
And
so that's why I couldn't find
I was asked by the World Bank to go evaluate the SME guarantee fund in Saudi Arabia, for example, and I immediately saw what the problem was. An SME would come to the bank. The bank would do its whole due diligence and all the documents and everything else, all their underwriting. And they say, yes, we'd like to make the loan, and they would submit it to the guarantee fund. The guarantee fund would start from scratch and go visit the company, and so borrowers just said, forget it, and the bank said, forget it. It was just, it took too long, and it was too onerous. So we've set it up that the banks have the responsibility to do the due diligence and make their loans. So therefore, the guarantee fund is like a surveillance body they monitor the performance of the banks quite carefully in the portfolio and the overall portfolio and the loans coming on a guarantee. But they don't look at any loan applications. They don't meet the clients unless one loan goes bad, and then the fund reserves the right to be able to audit to make sure the bank followed their own procedures.
And just one question, and then I'll
No, please. Yeah, it's better this way. Everybody can.
What is the then NPL of the banks of the guaranteed portfolio?
I haven't checked the most recent number.
Okay.
I believe it's less than 1%.
Oh, that's okay. Good, thanks.
But as you probably know, the NPL of the banks in Kosovo right now is actually quite low by regional standards. It's actually in reality a little bit higher than that because we know banks do things too artificially. But still, of course, all the region, the banks do that. So Kosovo, I think, has the lowest average NPL in the banks in the region or close to it. It's quite low now. It's come down quite a bit.
Sorry, I have a question.
Sure.
Technically, this was set up by who? What's the idea for the Kosovo
Guarantee fund. Because you're dealing with the banks. So this
Yes.
was initiative from European Union or from or from private donor?
Okay. As I said, in Kosovo, they were trying to do this for a long time. So there were several efforts in the Ministry of Industry and Trade, which also had the Foreign Investment Promotion Agency, also had the SME Agency, and they did brochures on various guarantee schemes and everything, and then they just never worked or never got funded. And then the UNDP proposed a guarantee scheme, and then the Austrian Development Agency proposed a guarantee scheme, and then KfW proposed a guarantee scheme, and none of them were working or could do it. Finally, the government of Kosovo, USAID, KfW, and Austrian Development Agency got in a room and signed an MOU to create the Kosovo Credit Guarantee Fund.
Okay. Which your organization has implemented later
Yes.
on. Okay.
So they had the MOU, but they still couldn't figure out how to do it. So they did multiple feasibility studies. And they hired global experts to do these feasibility studies. And each study said something different. And some said there's a great market for this. Some said there isn't. Some said it'll be sustainable. Some said it wasn't. I would get sent all of these feasibility studies. And then, of course, I would provide comments to the donors. This went on for a while. Finally, USAID said they would take the lead. And they funded a $4.7 million project to create the fund. So it was a combination of the government and donors that were the impetus behind it, and the big gap. So I've talked about the problem. So what did we do? At the beginning of the project, again, as I said, there were experts that were brought in to try and figure out how to do this, and nothing was working. They couldn't figure out what legal structure to do and then how to get money from the donors in. If it's a for-profit joint stock company, it's hard for USAID to put capital into that. And there's all these issues. So the banks pretty much gave up on it. The central bank gave up on it. And then USAID asked if I would come in and try and help do it. And I said yes under two conditions. One, everything that's been done so far goes in the dustbin. And we start fresh. And two, the existing international experts that have been working on it have to go home. So people said, well, Mike, that's pretty harsh. I said, no, you don't have to do it. I'm just telling you, because we need to start fresh. The banks, now were fed up and they didn't want to deal with it. So we needed a fresh start. So that ended up happening. So then I opened my big mouth, and then I had to figure out what structure. Well, it wasn't so easy. So I backed up and started with the Kosovo Constitution. Because in the Constitution, it lists all of the types of legal entities there can be. So I wanted to see what the possibilities were. It was quite a long story, and I tried everything, different ways of doing a joint stock company, an LLC, an NGO, a foundation, public agency, all those things. But I needed it to be able to be completely independent. So it happens under the Kosovo Constitution. There's what's called an independent public agency, and there's what's called an independent public institution. Independent public agencies report to the parliament, and the board is appointed by the parliament. So some 27 agencies in Kosovo pretty much don't function because either the parliament can't agree on who to appoint, or they appoint cousins or whatever that can't do the job, and they often don't have quorums on the board, so they can't make decisions. So it's pretty dysfunctional. However, an independent public institution, which had only been used once before for the Kosovo Deposit Insurance Company, is completely independent. It does not report to the government. It doesn't report to the parliament. But I tried to explain this to people, and they said, well, who does it report to? I said, it reports to its board. Yes, but who does the board report to? Because they're thinking of the share, who the share, then they say, well, who owns it? Who are the shareholders? And I said, the shareholders are the citizens of Kosovo. So this was tricky because people didn't understand it. And to some extent, I'm, pulling it out of the air, except it was in the Constitution. So it is a not-for-profit, independent public institution that's owned by the people of Kosovo. You have the ability to create a board to manage it. But to do that, you have to create the institution by drafting and getting passed a special purpose law to create the institution. So we had to draft the law, we had to get it passed by government, we had to get it passed by the parliament, and if you think it was easy explaining this to the government and the parliament about what this was and how could they have an institution that doesn't report to them, and of course people in the government wanted to know how they can get their hands on the money. So the law had to be very robust and have a lot of protections in it. We created a 7-person board. People were saying, why do you need so many board members? Well, you need an odd number, and you have to be able to have the independent board members have a majority. So the only way we could do it was to have a minimum of 7 members. 4 are chosen by USAID, KFW, Swedish CETA, who gave a co-guarantee. 2 from the government. 1 is the managing director, who's of course appointed by the board. And the board is the highest power. So the board makes all the decisions. Of course, the board consults with the donors because they want the donors to be happy and they want to get more money. So how is it capitalized? Well, because it's an independent public institution, not reporting to the government or the parliament and reporting to an independent board, the donors were prepared to put the capital in. So initially, roughly 15 million euros in capital was put in, and the money was put in what we call capital grants. So it becomes equity, but it's a grant. So the donors can't get the money back. They can't get a return on the investment. It's permanent equity in the institution, which is very helpful if you're going to guarantee, because the banks know there's that capital that can't be touched. And there are, in the law, rules about where that capital can be invested. And it can be in certificates of deposit in highly rated banks, or in highly rated bonds that meet a certain minimum risk requirement. Sure. Pardon?
Is it rated?
It's not rated yet.
And the banks are?
The banks are more than okay with it because of the amount of capital, because of the business plan, and the government of Kosovo, it doesn't have a credit rating either yet, so that really made it challenging. When we knew that we had the right business plan, the right operations, the right capitalization, the right leverage, was when Swedish CETA did unbelievable due diligence, and they were willing to provide a 10 million co-guarantee, because Sweden, of course, is one of the few countries in the world with a AAA credit rating. So that that certainly helped with the credibility of the banks because the Kingdom of Sweden provided a AAA guarantee. So the capital protected, and we had, of course, the banks had to see that that capital could not be tampered with by the government or by the management or by other people. And then the co-guarantee, of course, helped quite a bit. It started out with started out with a guarantee for SMEs, for loans to SMEs. And I had originally proposed a certain limit to the size of the loan. Everybody said, oh no, they'll want much bigger loans, they'll want much bigger loans. I said, in Kosovo, the average loan size is going to be 30 to 40,000. They said, no, we have to go at least 500,000 on it. So that was one thing I bent on, but it had to meet certain criteria. And guess what now? After 154 million euros in loans and 3 years, the average loan size is about 35,000 euros. Okay, so if you need to know the market if you're going to set something like this up. The average tenor, everybody said, oh, the average tenor was going to be 5, 7, 10 years. I said, no, it's going to be about 2.5 years, and it's proven it's almost exactly 2.5 years out of the loans that have been made.
So basically, sorry, what is the leverage then of the fund?
For the SME window,
Yeah.
the fund is allowed to go up to 5 to 1. In other words, they can guarantee 5 with 1 in capital backing
Capital
it.
base, yeah.
Now, they haven't reached that level yet, but they are allowed to do it. Now, KFW, for the ag window, KFW put money in specifically to finance the ag window. Of course, all the capital is together, but it's earmarked for the ag window. And they said that they wanted to limit it at 2 to 1.
2 to 1.
Yeah. So, and then now we'll watch the performance and we'll see it because that can be changed. Guarantee percentage is up to a maximum of 50%, but it can be less. So, if let's say that the bank has lent an SME 100,000, and with a 50% guarantee, and that SME pays and everything's fine, borrows again and everything's fine. The bank may now decide, and the company's more profitable, it's growing. The bank may decide, yeah, we'll give them the next loan, but we only need 25% guarantee. So they have the freedom to do that, and then it makes it more affordable. Another thing in all these feasibility studies and the experts trying to set this up, they didn't do adequate business plans. So the business plan I wrote was for 6 years. And 6 years of monthly projections. Now, those of you who have actually done business plans or reviewed business plans have an idea of what it's like to do financial projections for 6 years on a monthly basis. But if you don't do that here, you're not going to know if you can get there. Because as the banks put loans under guarantee, each loan has a different tenor. And how much your exposure is and how much reserves you have to take depends on how much loans are under guarantee. And month to month that changes. New loans come in and you charge a fee, and then some of the older loans get paid back. So it doesn't happen conveniently at the beginning of a quarter or the end of a quarter. It happens monthly. So and the banks have to report to the central bank for changes in classifications, risk classifications of loans on a monthly basis. So if you do projections on a quarterly basis, you could end up in a situation where it looks like you're profitable, but you run out of cash. So, and everything was calculated. Every salary, every benefit, office space, office supplies, maintenance of the computer system, legal fees, auditing fees, everything on a monthly basis. So when the annual external audit fee came, it was in the month that it would in fact be paid. So the cash flow analysis was very detailed and very robust. That was part of what convinced the banks to come with the guarantee fund because they saw how carefully the fund was projected. Interestingly, whoops, I think I went. Okay. So we had to create guarantee agreements with each bank, and 7 of 9 banks are members. The 2 other banks are newer banks. They don't have small business portfolios yet, so there's no point in them joining. Once they develop small business portfolios, they would be welcome to come on board. And then Raiffeisen Leasing, which is the biggest leasing company in Kosovo, has joined, and the purpose was they were primarily leasing cars and apartments. We wanted them to lease equipment for SMEs and startups, so that's why they joined the fund. As I said, all the loan underwriting is done by the PFIs. They pay fees for the guarantees. Guarantee fees must cover everything. We talked about the MIS system and the lean staffing. And interestingly, in the case of KCGF, it is not licensed and supervised by the central bank. And that surprises people. So it truly is independent. It does have to meet it has to meet all Kosovo laws, and there are certain central bank regulations that it has to meet because it is a financial institution. But it is not licensed, supervised, or examined by the central bank. Out of courtesy, we created a reporting mechanism to the central bank so it gives them a cross-check on what they're hearing from the banks, because we report certain aspects of the loans under guarantee, and the central bank has that information. But that's an MOU, just voluntary MOU. We drafted the Kosovo-wide regulation on guarantee instruments, which just explains what guarantees are. And that's it. Okay, so the results. With 15 million in capital, in 3 years, KCGF has guaranteed 154 million euros in approximately 4,100 loans. And these were borrowed, this was incremental funding. These are loans that the banks would not have made without the guarantee. About 6,200 jobs were created. It covers all sectors, not just trade. Most of the lending in Kosovo goes to trade, which doesn't create more jobs, doesn't create any of the economic benefit. But this includes manufacturing, ICT, and agribusiness. It's lowered the collateral requirements, and it's increased lending to women who have less than, about 1% of the loan portfolio go to women, and early stage companies. So based on the success, the EU provided a co-guarantee of 30 million euros, which again helps confirm the credibility and stability of the fund. And the World Bank, the board approved 20 million in new capital, part of which is going to go to a new window for startups and early stage companies, which is really needed in Kosovo, not just Kosovo, but of course. And there was MCC through Millennium Foundation Kosovo, which is their arm in Kosovo, was trying to figure out how to encourage renewable energy in Kosovo, which is badly needed. They thought of creating a new financial institution. They thought of doing all sorts of different things. The central bank and a lot of the donors suggested they talk to me. We met, and I said, why take years to reinvent a wheel for something so narrowly focused? Why don't you support creating a window in the Kosovo Credit Guarantee Fund to do project finance? There's very little project finance in Kosovo. So create a window to guarantee project finance projects, and as part of the program, train people in the guarantee fund, train people in the banks on project finance and energy finance, add a couple of staff people in the fund to do project finance and energy finance, and then it'll become a new instrument, sustainable, and so that's in the works. I helped design that, and now they're moving forward to provide the training and the capacity building, and hopefully then there will be one of the international financial institutions is considering a co-guarantee for that, and hopefully there'll be some capital as well, so they could do that. And then fairly recently, just the end of 2019, the European Association of Guarantee Institutions reported that the Kosovo Credit Guarantee Fund was one of the most successful and impactful guarantee funds in the region. Well, actually in Europe. So that was, we're very happy about that. So the lessons are that you can mobilize money from the banks for the kinds of companies that we talk about at World Business Angel Investment Forum. SMEs, women-owned businesses, agriculture, startups, early-stage companies. But you have to help reduce the risk to the banks. But they've got the money. You know, there had been a joke, and it was misappropriated, but it wasn't quite a real story. It was fabricated in a newspaper, I later found out. But the joke was, a reporter asked Jesse James why he robs banks. And his answer was, because that's where the money is. So we know where the money is, and it's there. Now, why do the banks do this? If you help the banks, if they have excess liquidity, banks in Kosovo are parking some of that excess liquidity in German banks and paying the banks to hold the money from them. They're not earning interest, they're paying it's negative interest for the privilege of having the German banks hold the money. So instead of losing money on that, if even after the guarantee fee, they can make a margin on lending to these companies, excuse me, with greater safety, it's in their interest. Plus, they develop a bigger client base for deposits, for payments and transfer, all those great fees the banks love to charge. So the bank, you know, it's like airports. People think airports make most of their money by charging airlines, landing fees and maintenance and all that stuff. Most modern airports now, 50% of their revenues come from duty-free, cafes, all that kind of stuff. Well, if you look at the financial statements of banks in Kosovo, the interest income's been coming down because the interest rates are going down, but their fee income is going up. So I joked to the CEO of Raiffeisen Bank Kosovo that every time I come within 500 meters of one of their branches or one of their ATMs, I feel a hand reach in my pocket. And he laughed and kind of nodded because it's almost true. The fees are crazy. But they make fees, they do make interest on loans, but they make money on every euro that comes in and out of the bank. So the more customers they have, the more loans they make more interest, they make more fees. So once the banks see how to do it and then they have some of the risk covered, they're willing to, in fact, do it and pay for it. And this can, or something similar, be done in other countries. We're looking right now, being asked if we could help in an African country do this. It can be done. There are guarantee funds and schemes that have been done. But really the question is, can it be done sustainably and on a revolving basis so it has long-term benefit? I think so, but you have to take these things into account. And independence and corporate governance is key. In the prior Masterclass, they were talking about public-private partnerships, and he said one of the most important things is the governance. And that's true here too. So questions, comments, criticisms? And if anybody's interested, I already promised, if anybody's interested, I'd be happy to, if you just give me your card or email, to send you the 2018 report on the Kosovo Credit Guarantee Fund, which is quite good information. And they haven't done their annual report for 2019 yet, but they did do a summary, which I'd be happy to share as well. Did you want a question?
Is there? Thank you very much. So I just want to ask, establishing a credit guarantee fund, must it be by a government? And again, is there, should I say, minimum amount you should start with to set up a fund? Is there a minimum requirement?
Okay, those are two excellent questions. The first, does it take a government to set up a fund? I would say that you don't necessarily need the government to set it up. In this case, this case, the fund was set up independent of the government. However, in order to actually do it, it needed government approval. And it also needed a law to allow it to be established, at least using this legal structure. So, in most countries, and maybe the independent public institution approach might not work, depending on the legal framework. But there's usually something like that legal structure, but it does often would require either a new law, which I recommend, or certainly government approval. If the government is putting money in, like they here, then of course they're going to need to be involved. But the biggest trick was, going to the banks and explaining the banks, and then having to go to the Minister of Finance and explain it, and then the minister. And there actually was a point when the then Minister of Finance said, "Mike, but this would really be great as we could make this also an employment fund." And I said, "Mr. Minister, I'm sure that's a wonderful idea. The problem is the donors have earmarked these funds for a guarantee fund, and the funds are going to expire. Now, if we start to modify it, and we'll lose the money. So let's set up the guarantee scheme. Then you can use this model to, but that's the trick is getting everybody on board. But I do think it's dual. Now, in terms of minimum capital, excuse me, it depends a little bit on what leverage you're going to use. But I would not advise doing this if between all the sources of the capital, you don't have at least 15 million in capital. Because you need to be able to guarantee enough loans so that the fees on the guarantees cover your operational costs and potential losses. So it's like, for my colleague other people here work in my colleague in North Macedonia, I went to a thing at the Marriott talking about putting a framework in place so people could create local investment funds. And besides the fact that there are higher priorities things because the law on trade companies is so bad, it doesn't matter if you set up a fund if you can't invest and then get your money out, among other things, which I raised. But they were saying, and the minimum capital for these funds will be 500,000 euros. And then there were some local people arguing, that's too high, it should be less. You cannot have an equity fund with less than 25 million because you have no source of income other than 1 or 2% management fee on the money under management. Because you don't have interest, you don't have fees, you don't have a return, sometimes for years. So if the fund is 500,000, how are you going to pay for your personnel, for office space, for legal fees? You just can't do it. So for a guarantee fund, it's the same thing. It's a little bit different, but you need a certain minimum size because you need operational expenses and you have to cover losses. And so you have to have a certain loan portfolio to be able to generate enough income. Now, the problem is if it's smaller, then you would have to charge higher guarantee fees as a percentage, and then it makes the financing unaffordable.
The capital of the fund is around 15 million.
It was around 15 million, plus and now it'll be another 20 million, plus the two co-guarantees of 40 million.
Okay, and the portfolio is guaranteed. How big it is?
Right now, I think, I forgot the exact number. The cumulative loans is 154 million, which would mean there was cumulative about 75 million exposure. I think the outstanding right at the moment is somewhere around 90 to 100,000.
Okay.
So the guaranteed amount, I think, is about 45 million.
45 million.
Yeah.
Okay.
And what is the lifetime of the fund?
Forever.
Forever. So these
Unless suddenly there's huge losses, which would mean they have to eat into capital and then they can't guarantee as much and then it's a downward spiral, or something else.
so far all the costs and losses are covered by the fee.
Okay, now that's a very important question. I'm sorry I didn't cover it because that's such an important question. To start the fund, like startup company, to start the fund, before you can start guaranteeing, you need capital, but you also have expenses. So in this case, there was a period of time where the donors, specifically USAID, provided grants to the fund to cover operational expenses until the loan portfolio grew enough so that the fees covered all the expenses. During that period, as I said, the average loan tenor was about 30 months. So in the first couple of years, it was too young to start seeing a lot of NPL. So USA didn't have to cover any losses. But there did have to be enough money so that the fund could make their reserves for potential losses. So in the initial couple of years, USAID, through a grant, covered operational expenses until the portfolio got big enough so that it was generating enough fees.
But the banks are in general interested in such an instrument because of I'm just referring to the NPL figure, which is very low, and then if the bank is comfortable with it, maybe they would not create additional costs of going into the credit guarantee fund. I was just thinking regarding the market demand.
Again, very interesting question. The average NPL in the banks in Kosovo now is, as they report it, about 4.5, I think. Okay, somewhere in that range, which has come down quite a bit. The NPL in the guarantee fund is much lower. Now, if you look at prior DCA guarantees, despite the fact that the loans were riskier and to riskier clients and to new sectors and everything else, the NPL was actually quite low. So it's an interesting phenomenon. Now, what's interesting is the bank started out skeptical, and the amount they asked for their ceiling on how much loans could be guaranteed was not that big. But several of the banks hit their ceiling quite quickly, and they asked to raise the ceiling, and now one of the banks, I think, is in their fourth increase. Several of them, I think most of the banks are on at least their second increase. So the banks keep asking for their ceiling to be raised so that they can do more. And I think part of it is, the question is if they can make these loans with such low NPLs, then why do they pay for the guarantee? But part of it is they're substituting the guarantee for real estate collateral. Okay, for example. So real estate collateral sounds great, right? But if you need to enforce against real estate collateral, you know what you have to go through. It can take a couple of years. So, and it's expensive, and it's, okay. So, and is the value of the real estate really what it looked like? In Kosovo, there is no way to do fair market valuation because the prices for real estate transactions aren't public. So, using the guarantee, the banks use the guarantee instead of real estate. It's more certain. It's worth the fee to them. And a lot of the loans they're making, like to agribusinesses and small businesses and things like that, that they wouldn't have made, they're not making at the same interest rates they're giving to the corporates. So their margins are higher, so they can factor in the interest. But we've seen the demand growing and growing, actually. And each bank has its own personality, as you know, but we're seeing them be more progressive. Now, if I can just get them to do more movable asset-based lending, like purchase order finance and things like that, I'd be very happy. But we're getting there.
Thanks.
Any other questions, comments? Well, thank you very much for coming. I hope it was helpful, and please feel free to, if you have questions some other time, just get in touch. I have my cards somewhere. Thank you.